Last Friday, the European Commission unveiled proposals aimed at making European banks more competitive. It's widely seen as a move to close the gap with US rivals. Well, on Friday, our correspondent Sasha Vakulina caught up with the European Commissioner for Financial Services, Maria Luís Albuquerque, and started by asking her what impact she hoped the proposals could have for European citizens and businesses.
Banks are very important in the European economy. They're important for citizens, they're important for businesses, for financing. So we need them to be efficient and to work well. We have found a few problems which need to be addressed, and we have, with this diagnosis, also indicated the way forward. So it is about making our banking sector better prepared to support citizens, businesses, and the Europeans' ambitions and vision for the future.
And what is it the key aspect here when it comes to the Europeans, to ordinary savers? If you focus on this category, yes. What is the key?
People typically go to banks for one of two things. Either they need to borrow money for a mortgage, for whatever objective. They should have banks which are efficient but also competitive, so that people can compare different offers and choose the one which is best. But also people save money and put money aside for a rainy day, for a pension, for whatever reason. And banks are often the agents, the intermediaries that people go to. So the more efficient the banks are, the more competitive the system is, the better will be the offer of such opportunities for our households wanting to save and invest their money.
When we look at the world of big powers, does Europe need more cross-border mergers, meaning probably fewer but bigger European banks and therefore more consolidation?
Yes, we need a few big banks. But if we compare the average size of even the bigger European banks and our competitors, who also operate in Europe, by the way, namely American banks, the size is completely different. And for some areas of business, that scale really matters. We have identified the fragmentation of the banking sector, or the incompleteness of the single market in banking, as the main problem holding us back in terms of competitiveness. That is actually the bigger problem we have discovered. This makes it very inefficient. This perspective of looking at member states in isolation is actually very costly to the European economy. I think that member states, they come from the past where we looked at this from a national perspective, but I think we have all realized that our true competitors are other blocks. So it's Europe together with our other competitors. And that requires that change in mindset. Of course, it's difficult. It's a significant change, and there is a normal resistance to change. But I think the fact that there is awareness and the conscience that the costs of not moving are increasing, I think we have now better conditions to deliver on those objectives.
The report argues that Europe's banks need to take more risk if they are to finance growth and compete globally. Where do you draw the line between encouraging certain risk-taking and avoiding the mistakes that led to previous financial crises?
It's not banks that need to take more risk. It's the whole Europe that needs to have a different approach to risk. So, because of how we are, also because of cultural elements, but because of some inefficiencies in our system and still the legacy of the previous crisis, we focused a lot on reducing and trying to eliminate risk. But if you eliminate risk, you eliminate opportunities. We know that risk-taking is indispensable for innovation, for economic growth. So what we are talking about here is a recalibration. Now, we need to adjust the parameters of the framework to say that some more risk-taking should be considered in the system as a whole when it comes to financing certain activities. But this is the political discussion. How much risk are we comfortable to allow into the system preserving financial stability, because financial stability is a precondition. Without financial stability, nothing else works. So we need to find the right balance. What we are talking about here is rebalancing, allowing some more risk while preserving financial stability. It's a recalibration. It's not going back to the past, because we have learned the lessons and we are much better prepared to manage risk in a sound and prudent manner now.